Hello, everyone. It is time for an installment of the Eosio Spotlight series brought to you by the team at Helios. And today I've got a special guest, Daryn from the UX team, UX Network. And this is his first time kind of probably being exposed to the Eosio community. He's been working in the background for quite some time. And finally, you get to meet him. So Daryn, thanks for taking the time for being here with me today.
Yeah, Chris, thank you. Pleasure.
So I think maybe first, just before we get into UX and some of the information that came out recently on the Eosio Core Plus call, maybe talk a bit about yourself and your background.
Okay, so my background is very traditional finance, so hedge funds, investment banking, and private equity. And yeah, I only got into crypto about 5 years ago, I guess. When I looked at, for me, I was very interested in the flow of value between centralized economies and decentralized economies. I just take a view that over the period of the next 10 to 20 years, economic control will shift from the current sort of tech giants that dominate the economy into the hands of a much more efficient system in the long run, a much more efficient system where there is kind of distributed wealth in return for distributed contribution. I mean, that's my philosophy. So blockchain for me kind of represented an implementation of that, like a technology implementation of a much more kind of vertical philosophy around the way that commerce and businesses could operate. And that ties into a very kind of big sort of like social thing, which was kind of highlighted by COVID, I guess, which is like, actually, you don't need to go, full employment is a kind of misnomer. It doesn't make a lot of sense. How can you leverage resources that aren't kind of constant? I'm not doing a 9-to-5 job, but I can do an hour here or an hour there. So all of a sudden I can start to model, in a workforce, kind of distributed economies. So I just think there's a very interesting sort of confluence of factors, social, political, and economic, that all came together around about the time of blockchain, around that time of crypto. And we're seeing that play out now. I don't see it playing out tomorrow, and I don't see it playing out in 2 years' time, but I do see over the next 5 to 10 years, this kind of shift of power and value transfer. Yeah, value enhancement, I guess.
So it wasn't a very difficult sell to get you into this concept of tokenized assets, nothing tangible.
Yeah, it wasn't, because I think I understood it quite quickly in terms of it from a financial perspective. I think lots of people don't understand how to value tokens and how to kind of see what they do. And I kind of grasped that quite quickly, whereas my kind of peer group in traditional finance were very much, it's rat poison, it makes no sense, it's not based on any assets, and I'm like, well, yeah, that's the first thought, but the first thought is always wrong, because that's your conditioning. You're conditioned to think in that way. And I'm a contrarian individual by nature. So for me, I'm always looking for the kind of the view that no one else has, I guess. And in my peer group, which was very much, banking and finance, I was quite pleased no one else liked it, because it removed all of those people that would show me up to be not as clever as them. And right. I could just get on with what I was doing. So yeah.
Proof you're onto something.
Yeah.
Yeah. And the plight of a contrarian, right, is you're always wrong until you're right. Take some conviction.
Well, if you do the same as everybody else, like it's just like law of large numbers. You keep betting the same way as everyone else, you're going to be on the wrong side of probability. So you might make some money, but it's kind of negative expected return in the end. Whereas if you're doing the opposite to everybody else, you probably get it wrong quite a few times. I mean, that's okay. But when you get it right, it's a better return on effort.
Yep, makes a lot of sense. A lot of Bitcoin hodlers today would very much align with that concept, because it was certainly a gamble at the beginning and it's paid off pretty well up to now.
Well, yeah, I got into. I mean, I got into Bitcoin. Like, I didn't buy loads because I didn't have loads of money at the time. But the guy that got me into Bitcoin was Brock. He probably won't remember, but I met him in a bar in, like, just after Mount Gox went bust, and he explained Bitcoin to me, and I said, well, and at the end of it, he said, oh, do you think it'll go back to $700 because it's like $300 or something? And I said, look, I don't know what it's going to do. He said, it's not $700. It's either zero or it's $1 million. Everything else is just a probability weighted number in the middle. It's not. You can't look at it like that. And yeah, but that was when I first discovered Bitcoin. So
interesting. So okay, thank you for the background. That's great. And I want to get to this kind of the crux of what I think is really important that we talk about, and that is the UX network and what your Eosio blockchain is going to be coming out with this year. I understand this is a big year for you guys. So on the recent Eosio Plus call, so these calls happen every Thursday, and they're recorded. Rami James from the Ultra team, also doing work on a few other chains as well. He puts these up on his YouTube, which is great. And so the most recent call, this proposal coming forth from your team was mentioned, and not a lot of details, but this is what was mentioned by Eve on this, is paraphrasing. Basically says this work was started by the UX team well before the EOSIO Plus group began. This is intellectual property that the UX network was going to release on its own, but has since been recognized that there is an overlap that could align the financial incentives between the different chains, and could also be used for the purpose of determining how that group, this EOSIO Plus group, could share a treasury. Now, there's a lot there. Key points for me are alignment of financial incentive and sharing a treasury, because those are two really, really big pieces for many of us in EOSIO. We want to bring these chains together, stop the infighting, and then the fact that that EOSIO Plus group it's going to be expensive to maintain the core code. How does that get funded? How does that get shared amongst all these disparate chains?
Yeah, I mean, I think that it all started really when you've got to look at the capital structure of EOS. Let's take EOS. And the crux of the matter for me with EOS was the capital structure was wrong at the start. And it was wrong at the start because if you take the lessons from, say, Ethereum was built on, all right, not quite, but volunteers. It was built on an ethos of development where people were rewarded for their work, but there was a community of developers that was very strong, and ultimately have got it to where it's got to now, which is incredible invested capital, both in kind of time and money. To do that, you have to have a reward or an incentive system as part of your capital structure. There has to be something where the principles of economic value added need to be rewarded. Mm-hmm. You can't expect people to build aspirationally or in isolation, hoping to gain, to be rewarded, because it doesn't work like that. The world doesn't work like that. So Block One, I think, made a big mistake when they went down a very classical route, a very classical Wall Street route, if you like, which is we own 100% of this. We'll sell 90% and take the cash. I mean, there's nothing wrong with that. Like, I'm not casting any passing judgment on what they did. Right. But what it left you with the community became very toxic for a very simple reason, because it was complete misalignment of interests. You had 90% of the people that own the tokens were passive investors looking at Block One saying, what are you doing for me? I've given you my money. What are you doing? Whereas I'm Block One and I'm just like, yeah, but I own 10% of the chain. So, okay, well, we'll do 10% of the work, but we ain't doing 100% of the work, right? Because by the way, it isn't just me, Brendan, it's me, my shareholders, it's Galaxy, it's Alan Howard, it's like all the, they're not going to look kindly about, they're going to think I'm a shit businessman if I'm like putting up 100% of the money for 10% of the profits. It makes no sense. So they ended up in a, right or wrong, a very difficult situation, but it all comes down to the fact what could they have done? They could have sold 50%, stuck 40% into a development pool with some kind of, issuance algorithm. There would be a very different experience on EOS now had they done that, and arguably their wealth would have been much bigger, because they would have their 10% would have been worth maybe 10 times as much.
Mm-hmm.
So well, yeah, like 2 billion or 20 billion kind of makes sense, right? So so that's history. There's nothing you can do about it, and you're stuck with it. Nothing you can do now. So there are two things. We came up with a structure which we call arguably the super token. And the super token was designed to do two things, and one of them was what I just mentioned: is try and fix the capital structure, which allowed for a pool of tokens to be available for on-chain funding of some description. I'm going to come back to that in a second. The second part of it was a very practical capex issue. So for a while, for a while, the Eosio code base, everyone had a free ride on it. Block one, you put through, they worked on it, they built, did the upgrades, whatever. Now we realized at UX Network that music was going to stop at some point, and we actually have our own views on how the code base for us can be developed, in terms of some aspects that we quite like a hybrid proof of work type structure, looking at some quantum key signatures, so various kind of add-ons to the code base that we think would add value. But that's us. That's just kind of where we saw it, and we know that roughly, well, it's going to cost us about $20 million over the next couple of years if we wanted to deploy that strategy. To really turn it into something that's, I don't like the expression, but enterprise ready, or whatever you want to call it, something that's going to pass muster with a kind of with a proper corporate, with a proper entity that's going to do due diligence on the kind of architecture of the chain, and know that it's ultimately safe to outsource their back office to that blockchain. And that's kind of what you're looking at with this kind of enterprise adoption. Mm-hmm. So that's fine, that's okay. We recognize that. But of course, now you've got at least 5 other chains that all have the same issue, where they're all going to spend, in theory, they've all got to spend the $20 million, right? So it made sense to me that, well, if you've got 5 chains that spend $20 million each for a common code base, and there's also a kind of another effect with this, which is because it's open source, I spend the 20 million, you don't, you spend a couple of million, but mine's better than yours. So now you adopt my code base. So there's this kind of look back option, which everyone has against each other. So it's a complete mess, and then you've got the problem where, okay, so, UX Network is probably still, a stage behind in terms of decentralization from where from a few of the other chains, which is because we recognize that we have to kind of capitalize this properly in terms of this kind of capex build that is required. Mm-hmm. But actually you're in a worse position if you're decentralized, because now, or distributed, whichever the term you prefer, because now you're saying, oh shit, I'll spend $20 million. So in theory, every token holder has got to contribute to and no one's doing that. They were looking at each other, because it's like, well, that's what block one used to do. So what's simple about it? So it's a massive problem. So it's very, and the simplest way to do it is to say, well, why don't we take this concept of this super token that we came up with, which would say that the super token as this kind of as this entity, whatever it might be, would acquire stakes in every chain, and we kind of picked 10% stake in every chain. So every chain would swap 10% of their tokens for a fixed amount of super tokens. So we'd end up with token holders that have got super tokens. We'd end up with a super token, which has a basket of Eosio chains that wanted to or were deemed suitable to participate in the super token. Mm-hmm. And then within that, we create a headroom. So we don't allocate 100% super tokens for the basket. You know, we put like a 25% headroom on it, which gives us a capital base. So you can't make money out of thin air, right? So you could argue, well, hang on a minute, where's that 25% come from? But if you think about it logically, if a chain as a collective hands over 10%, and it has a 25% dilution effect on 10%, it's kind of the inverse, but it's a 2.5% dilution at the chain level, which kind of solves the problem that everyone is contributing by getting a natural small dilution into the super token. So everyone's contributing, but the cost savings, like just think about the cost savings of everyone's saving $20 million for one spend of $20 million. So now you have a super token which assumes the liability, the financial liability for investing in the code base. And in return, every chain that is participating shares in the governance of the super token. So why is that valuable? Well, it's kind of, if you want to know the development progress of the code base, because you don't want it to change overnight one day and you didn't know about it and now none of your contracts are working, or you can't upgrade or whatever it might be. So so there's a kind of, it's still open source, and it's still, in theory, some other chain can say, oh, I'll use that code base, that's cool. I don't need to give out the super token. I'm not worried about those guys, but they won't have any say in the development. Like I said, they won't have any support, and not in a malicious way, just in, this is a community effort. Now, when we do this, there's a kind of secondary effect, because now we've got this headway in the token balance, which can be used for funding back into Eosio, but in a genuine way that says, why are we funding? What's our commercial strategy? What is the Eosio? What are kind of protocols that perhaps can't be funded on their own because they have no profitability as a standalone business, or as a standalone token, or whatever it might be. They don't even need a token, but would they bring value to Eosio as a protocol? So it can fund activities like that. It can fund development groups, and it could be more, and then more of a treasury management exercise at a higher level, like in terms of having some commercial acumen, which is like, where is the end user? How are we, what users do we want to attract to these different chains? And the beauty of this is it doesn't affect any of the individual chains, their own business models. I mean, it doesn't say anything about you need to do this, or Wax needs to do that, or Telos needs to do this, or UX network can't do this. It doesn't matter. Like, it's more about, it's a real kind of like, it's a simple cost sharing exercise for the code base, which takes away a massive problem for everybody, including us. And but a vertical commercial enterprise that enables economic value to kind of get put back into these chains and start to bring these kind of catalytic benefits for economic expansion. But the lovely thing about all of this, I think, is that it rebrands Eosio as a kind of much bigger asset base, because Eosio is like, I say this to people, they don't believe me, but it's by far the most superior blockchain out there. It works, it's been around, it's battle, it's done everything it's supposed to do. It doesn't go down, it doesn't, all of those things, whatever, I'm not into them. But it works. And it's
the choir on this call.
Yeah, but it's like, it's a massive sleeping giant, and it hasn't been to this point leveraged properly. And with the right narrative around, okay, now we have we have this kind of, we create an economic power base just by the existence of something like this.
Yeah, well, you mentioned that it hasn't been leveraged properly, but it seems to me when you mentioned about what Block One did and didn't do, there was just a misalignment of incentives. Like, we haven't all been pushing in the same direction as a united community, and this gives people an opportunity to align ourselves to kind of cheer for everyone and try to push in the same direction. Because I think it's important to notice, you mentioned this super token gets built up from an allocation of all the various participating chains. So to clarify, that's made possible because of UX's IBC technology that you've developed, right? And then secondary, does that also allow the individual token holder to also participate, or is this something that only foundations for each of the chains participate in?
No, it's an open offer effectively. So any token holder should be able to swap their token for a super token. I mean, I think that's the kind of beauty of it, that it isn't, it would simply be, right, so we've done some work around how to determine sort of various ratios between chains that have a market cap and what their kind of balance of super tokens should be. And it's quite difficult because there are so many different nuances around, liquidity, and Eos is the biggest market cap, it's the most liquid, but at the same time, there is a correlation between market cap and liquidity. So it's kind of a bit of a double count. Like, you can't say, oh, we're the biggest cap, but actually we're the most liquid because, well, you are, because that's right. So we've come up with a couple of like mathematical techniques and analysis to look at how to kind of balance that effect in the initial 10% stake building exercise. So there's a kind of there's a sort of small, Eos will get less of a share than it should do because by definition there's no point creating a super token which is just 95% Eos. I mean, it doesn't make sense. Like, there's no diversification. So for a super token investor, like as an agnostic investor, if I looked at it and wanted to invest in Eosio as an asset class, rather than any one particular chain, you'd want a more diversified pool of assets underneath, and also you'd want the governance of the super token to be incentivized sort of similarly to its asset base. And there's no point, otherwise there'd be a misalignment of interest between, okay, the governance wants to invest in things that are maybe good for the smaller chains, but the bulk of its assets are in the bigger chains. So it would just be a strange, it would just actually defeat the object of the whole exercise. So yeah, and I mean, as you alluded to, that we built this this interesting technology, IBC on UX network, and it actually is, well, frankly, it's kind of like the ultimate in IBC. If I'm completely honest with you. I mean, I can take no credit for this, as you know, but it solves for IBC through user cryptography. So there is no third parties. There's no kind of like guy with a server that you're relying on to turn his servers on in the morning, and if he doesn't turn them on, you've got to pay him some more money, and you've got to wait maybe a few hours for him to go and get his lunch or whatever, whatever. Right? There's no federated oracles. There's nothing like that. This is all done through at the user level, and so one, it's it's incredibly exciting within an Eosio context, because it actually really, you're creating what in effect would end up being one big blockchain through IBC, through this type of IBC. Now, if you think about it, if you think about something like Solana, for example, Solana is parallel blockchains, so it's not one super fast blockchain; it's kind of a bunch of chains together, and that's the reason it's as fast as it is. But they're all linked. But they're all linked with a very risky, centralized kind of system, which introduces a lot of risk. So for the moment, people don't really care about that. It goes down from time to time. And, again, I'm not critical of Solana, because Solana does what Solana does. It's very successful. So that's, it's fit for purpose for certain things. My personal obsession is much more about leverage of distributed technology and using cryptography and kind of mathematical incentives to create security. So if you took Eosio in the same context as Solana and put Eosio chains in parallel and hardened the bridge with our IBC technology, you're going to get millions of transactions per second, and a much greater a greater level of security than you'll get with any of these other chains. So the IBC is just very interesting for a number of reasons. It's not just about wrap tokens, it's about data transfer, potentially imagine KYC or identity being transferred across chains. So it becomes, it's a very, very, it's a very cool solution and a cool bit of tech that we have there. And yeah, no, so that and it's free. We don't charge for it. There's no, why don't we charge? Yeah, people are like, well, why don't you charge it? So, well, why would you add another friction point into what we're doing? It's all about driving utility into a layer one blockchain. So if we have, the ability for people to bridge into UX network, and we can build separately, but why wouldn't we build things like, DeFi aggregators, as an example? The value isn't in adding more friction. The value is in creating utility, which obviously does drive value ultimately into the network and into the capital value of the network.
It's the opposition of law of scarcity, right? It's the law of abundance, where you want to be as frictionless as possible so you can create abundance for everybody.
That's my view. Yeah, I mean, I think I'm like I'm alone in crypto for believing this, but for me, I'm all about reducing friction, and I don't understand why. It's less so now, but there was always, I think there was always an attempt within general sort of the crypto communities or crypto projects to basically destroy the user in favor of token holders. And I never got it. They're your bread and butter. You're not a price maker, you're a price taker at the end of the day, because you can make lots of blockchains, right? But there's only a finite amount of users and dollars that are going to flow onto them. So for me, it's like, and I'm used to price erosion, price margin compression, especially in financial markets. You don't charge, 20 basis points for a trade soon becomes you're paying away money for the trade. And so for me, I'm always like, look, take the market where it needs to go. Like, it needs to be free, it needs to be cheap, it needs to be easy to use. And don't try and double charge, don't put fees on fees on fees on fees. Because that also happens quite a lot in decentralized networks, because you have all these individual protocols that all need to fund their own capital. And so you end up with too much irrational pricing, and therefore the kind of integrated stack becomes too expensive to use. So that's sort of unavoidable, but in the end, markets kind of sort themselves out because competition drives prices to where they need to get to kind of fit together and work. So, but yeah, so IBC on UX Network is very simple. We structured it as a hub and spoke model. So we protect like the IP for UX Network in the sense that it's open source. You can use it. You can go EOS. You want to go to EOS to Wax, you go EOS UX Network Wax. And yeah,
it's probably worth mentioning. So UX stands for utility X, right? So this is your part of your ethos here with this chain is actually to be useful. It's for utility, and this IBC functionality, like you say, it's much more than just a pegged token swap. This actually allows, like Wax is a great example. That's the most highly used blockchain out of any blockchain right now, and it's going to reach some limits here. It needs some help. It needs some of this hub spoke functionality to allow it to offload some of its smart contract function. So conceivably, this IBC can be used to take a smart contract that's running strictly on Wax, and now part of that contract can be executed on UX instead, thereby, like you mentioned, getting to 1 million transactions a second. That's how, through this horizontal scalability of IBC.
When I looked at, I get lots of projects turn up with they want so it's part of our business model is where we occasionally, not so much anymore, we write token models, and they always turn up. They'll say, oh yeah, I need a token model. I need 1,000% APY staking or something, whatever it is. And I'm like, yeah, okay. And they say, we want to launch on whatever it is, the usual, Ethereum, Polygon, whatever the current, Avalanche, whatever. And I'm like, yeah, cool. And typically these are real businesses now. They're not so much crypto natives. These are people that come from maybe the music industry or something like that. And so, I've got these users and they're kind of used to Spotify and stuff like that. And I was just like, yeah, you do know that you probably aren't going to get the same user experience on Ethereum or Polygon that you're used to in like your users are used to. Like it can be quite a shock. And they're like, yeah, but that's where the money is. And I'm like, yeah, okay, that's cool. That's where the liquidity is, right? So that makes sense. But my view is, well, with something like the bridge, it gets really interesting because now we're saying, you know what, like, yeah, you do want to tap into that liquidity on Ethereum. That's right. But don't run your smart contracts over there,
right?
Because the operational experience will be, everyone, that's not derogatory to Ethereum. Like it just is. It's like you're paying for something else when you use Ethereum. You're paying for liquidity. You're paying for, when you launch a liquidity, you're paying for the access to capital. And that's fine, but you got to know what you're doing. So build your smart contracts on UX for utility. So run your utility contracts there. Bridge out, bridge out your liquidity token, if you like, to Uniswap, SushiSwap, wherever you want to do farming, liquidity pools, lending. That's cool. It's all done over there. That's fine. But at the end of the day, then you got the best of both worlds. And now you get something that's more interesting, because if you're a DApp, if you're planning your resource allocation, if you're planning your economic model, you can start to look at what parts you build where, and that makes multi-chain deployment kind of a commercial reality, and not just something that we kind of like bandy about because we think it's cool to talk about. But and then there is a kind of very interesting effect of IBC, which I find really funny. So if you go to any other these big layer one chains, they're very focused on user acquisition because that's how they get valued, right? Like you got 2 million users, that's $1,000 a user, that's $2 billion valuation. Yeah, that's pretty cool. I can tell all my investors, I can do my Series C, blah, 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 blah. Very classic kind of, again, Wall Street kind of like mentality, which is fine. That's kind of what they do. But it's user trap. Now they may talk to you, oh God, yeah, the holy grail of IBC, it'd be great if all blockchains could talk to each other and it would all kind of like live happily ever after. But that's like fundamentally antithetical to their business model. Their business model is like, you get a wallet on this chain, you ain't going anywhere. We're going to make it so hard for you to like, it's a nightmare. Some of this, if you want to move from like Terra to like Coinbase or something like that, you can spend hours like just going here, there, and everywhere. And so in a way, we've got a system which crypto started off as very much, anti-establishment, but it's become actually quite establishment. Like a lot of the models now are very centralized. People, there's someone to me the other day who works for an Oracle, a big Oracle, said to me, yeah, we don't care about centralization. Decentralization. No one cares. Like it's not a factor. And I was like, well, you might not care now, but I don't know. That's not what I subscribe to. Whatever. So
censorship isn't a problem until you're censored, I guess.
I think people will work it out soon. But anyway, it just I forget where I was now. But I've lost my thread.
I'm sorry. Yeah, I threw you off with the censorship comment on decentralization, and people many now are okay with the centralized model, not recognizing the value in decentralized.
Yeah, but my point is that so I guess coming back to like all of these, oh yes, that's what I was saying. So once so we've ended up with like a very almost the anti-establishment is establishment, but IBC is the disruptor, because IBC says you're now transient. I don't control you as a user anymore on my chain. Like you can go where you want to go, which means you have much more choice about quality of products and quality of user experience, and personal benefit. Like where am I best off? Where is my where's my wealth experience? Where do I want to go? And I think that will unravel quite a lot of people's business models, because it's not been about the tech, it's been about the user acquisition. And I think for me that's interesting.
Well, yeah, and what's so interesting further, I think, as it relates to Eosio, one of the questions that I've sort of wrestled with and Helios has wrestled with is what is the raison d'etre for each of these chains? Like what is EOS trying to be? Wax seems pretty clear that they've got a focus and niche on NFTs and games. Ultra, very, very clear niche there. Proton seems to be kind of going down the path of more financial tools. Telos, they want to be a hub for Web3. Eos probably maybe closest to Telos with this Web3 thing, but it's not being manifested necessarily, and it doesn't seem like the community even recognizes that. So this idea of IBC can allow the opportunity, well, okay, let's just pick something and focus on it, because we don't need to be everything to anyone. Because the IBC, now you don't, it's not, EOS shouldn't try to be necessarily the NFT center, because you already have Wax. So just recognize that and then pick something and really focus on it.
Yeah, I think that's right. I mean, I think it's always difficult in a kind of decentralized context to establish business lines. I think that's tough. And unless you have a very kind of clear focus, like I think Wax did, and they were very early. They kind of, it was kind of, quite visionary the way they approached it and the way it was achieved. So, I think that's fantastic. I see Wax as more of a business than as a blockchain in reality. It's a business that leverages blockchain. It's pretty cool. Yeah, there's nothing wrong with that. And I think that what happens is we're so early in this evolution that I almost, defining a business model for a chain is almost quite limiting. Like I almost feel that it's still too soon. I mean, our model is very much build upwards, but build tools that ultimately support the retail layer or the consumer layer, but there's no point going too quickly to the consumer layer if the tools aren't there to support it, because you end up losing users. I had this discussion earlier today where I said to someone, look, we've got some applications which designed 2 years ago. I could have launched them 2 years ago, but they wouldn't work properly. They wouldn't be fully supported. And people would just say, yeah, it's not a bad chain, but we use that application, and like,
it's clunky.
It's horrible, So there's lots of parts to this puzzle and there's lots of pressure externally which says, why haven't you got this or that? And you have to kind of ignore that a little bit and keep focused on the plan at hand, which is like keep building this support layer, keep building these protocols. Then we ourselves as Origin rather than UX Network, but we want to build those applications. Like we know what we want to build. Now that doesn't need to be the business model of the chain. It just happens to be the things we care about, because they're the things that we would use because of a background in finance and trading or investment. So I always look, DeFi type structures. I tend to like DeFi that's more innovative and more, I kind of get a bit bored of seeing a recreation of a traditional market put on a blockchain for no real reason other than just because it could be blockchain. I think that's a bit of I don't know, it's a bit boring. I prefer things that are a bit more interesting. And I prefer things which have a use case as well, rather than just a few kind of trading funds to bet against each other. So I think that's good for user engagement. But in the long run, I prefer things which have a kind of a solving problem. Like, for example, we've built a smart contract default swap marketplace for UX Network, which kind of sounds a bit DeFi, and it kind of looks and feels like DeFi, but actually it's a very sensible piece of kit which enables anybody to kind of hedge their risk against a particular smart contract. So if there's a hack on and it doesn't have to be on UX Network, it could refer to any chain or any kind of smart contract. It's just a reference address. But it solves a real problem that currently exists in blockchain, which we have hacks all the time, and there is no recourse. We have auditing firms which have no obligation or liability. They just, we audited it. Oh, we got hacked for $100 million. Oh yeah. Sorry about that.
Missed that one.
Give us another $50,000. We'll take another look at it. Maybe it's not. So it's a non. So we wanted to create a platform that gave this kind of use case. What is the use case? Who is the user? The user could be multifold, but it's kind of if it's it could be the applications themselves hedging for their user base. So if you're a big DeFi protocol, you can actually hedge you can hedge your own risk of being hacked for the benefit of your users.
So you can cover, yeah.
So you've got effectively, an insurance fund that can pay out your users in the event that there is a hack on your system. So this kind of like, and then you get the argument against that is, well, hang on a minute, if I can take a big bet on your contract getting hacked, isn't that going to incentivize people to go and hack your contract? Because we can bet on it. It's like, absolutely, but that's the only way. Again, in this world that we operate in, that's the only way to capital efficiency, risk and payout will define the system.
Yep.
So people will stop making shitty systems. Basically, they'll grow up a little bit and spend money on security and making sure that they're not vulnerable. Or everyone's always going to be vulnerable to a certain extent, but they're not stupidly vulnerable.
No, yeah, that's a traditional finance thing that's being brought to this new.
It has elements of traditional finance which we've changed to meet the requirements of this particular type of risk, but it blends nicely into a kind of like a crypto DeFi protocol. It's all on chain. There's no judge and jury. There's no me or you sitting there going, was it a hack? I don't know. Yeah, let's call it a hack. Yeah, pay out. There's none of that. It's all it's algorithmic. It's auditing tools, and that's the stuff I like. So it kind of ticks a lot of boxes for me.
Yeah. So for maybe just before we wrap up here, in terms of the UX network, so those who aren't familiar, maybe this is a big year, right? So that there's no true price discovery yet. Like these guys have kind of been stealth mode, not wanting to hype something until it's ready, which I can respect. Like you see a lot of projects come out and they hype the moon to raise some capital and then they don't deliver anything. Well, you're doing the exact opposite. You're not hyping anything. You're just building. And I think that's gonna be, I can certainly appreciate that. But for those who aren't familiar, where do they find out more about your platform? And can you tell us anything about what's coming next and what people should look forward to?
Yeah, I think we're at the point where we've built enough stuff that we're okay to start. It sounds like really kind of some sort of secret society, but we're okay to start. Being more releasing. We're in a phase now where we're releasing quite a few bits of the technology. So we're releasing the bridge, obviously, but with the bridge comes our AMM, which is an exchange that sits inside our Utility X exchange. So we have a Utility X, which was originally designed and still is designed to be a digital commodities platform. So its primary goal was to price discovery on the cost of resources. Mm-hmm. So now, again, that's quite interesting because we built that very early, but then quickly realized that it would actually serve no purpose until there was actual use of resources. It's a bit similar to Rex, I guess. There is no return because no one's using it.
Right. So, what does price discovery do for something that no one needs to discover?
Yeah, it's actually, you don't want that price discovery. So, but the theory behind Utility X is all about if I can extract the dollar value of utility for any given time period, I can create a dollar utility yield, which can then give me a kind of much better understanding of the relative dollar prices of tokens. That was the idea. But anyway, and that's still fine. And I like the idea because for me, again, there is a use case for that. There is a use case. I'm an application. I want to plan my resources. I don't know how many tokens to buy. I don't have to stake. But guess what? I can fix my resource costs for a year. You pay like X amount of dollars for these many actions, and if I need more, okay, cool, I'll go and get some more. But there is there's an industrial use case there's a demand. Assuming people want to use the resources, there's a demand. So it makes sense, and it kind of does that. It optimizes the blockchain. It kind of allows resources to be freed up, blah, 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 blah. All very nice. But that's, and we're still kind of playing with that and versions of that. But the quicker, the kind of side like that is that obviously we list tokens inside utility X. We want to have liquidity in tokens inside utility X. We have an order book structure, but we're also launching an AMM, which is obviously something that's quite good fun. And our AMM, it's a very flexible tool. It can be, you know, as many assets as you want in the basket, multiple weights, one-sided liquidity. It's very functional, it's a powerful piece of kit. Nice. So that's the kind of, so we're launching the AMM. You know, people can provide liquidity on the AMM, and then we have obviously our Oracle protocol, but then we've got a very interesting project again we built quite a while ago called AXE, which is our kind of decentralized asset manager, which is, you know, a bona fide decentralized protocol that deals with incentive structures for people originating trades in crypto, optimizing a portfolio, and providing a sort of a dynamic fee arrangement between traders, optimizers, and investors, that respond to sort of, you know, the capital in the system.
So it's like a decentralized hedge fund of sorts.
It's a decentralized hedge fund, but it's so in terms of, like, you know, strategically, why would we do all these things? Again, base protocols, you know, AXE needs liquidity. AXE needs a bridge to different chains. Yep. You know, it needs an oracle. So in this way, we kind of start to demonstrate the power of the chain and the power of the protocols that we built around it. Yep. And at that point, or as a parallel process to that point, is when we're able to say, look, this is a cool chain. Like, is it the best chain? I've no idea. Is it the worst? No. But it does some cool stuff. And here's how it works. And actually, we're the off takers of this product. Like, we're not just building it and going, oh, okay, we're going to pay a marketing firm 100 grand a month to just go and find users and hope they all use it and drive us all mad in Discord and Telegram. It's not about that. It's demonstrating the commercial viability of UX Network. Why does it work? How have we thought about it? Why do all these pieces fit together? And that starts really basic things like, you know, efficient resources, like you said earlier. Make it cheap, make it viable, make it usable, and that's been our process. So it's taken a long time, and we deliberate over these things.
Sure.
And but now is that probably that pivotal point where we can be a bit more, okay, we built this stuff and we should talk about it, and that's where we are.
Well, that sounds incredible. Yeah. And I'll fill in a couple of blanks, I think, just because I have done a bit of research. And so utilityx.io is the site that folks can check out, because that you can see you've got a swap coming, and there is an opportunity to acquire some UTX tokens, which is your native token there. It's just a one-sided trade, but once the AMM comes up, then that will be liberated.
Well, that whole so UtilityX at the moment is about to be rebranded anyway. So
okay,
yeah. So with the AMM coming along, we actually we're rebranding the whole thing. So I mean,
have a look temporarily.
Yeah. I'm just, you know, you keep going back and looking just in case.
Yeah. And then I think it's interesting to point out the way I understand the UTX token, when you talk about this utility, the really clever dynamic that you've come up with is you split the token ownership into two pieces. And one piece represents, because right now, say the closest analogy is probably Telos, where in Telos, you own a Telos token, and that token not only represents ownership of the token, but also network bandwidth. So when you stake your Telos to Rex, you then own that token, collects yield, and then you also have access to network utility. Your approach, I think, is clever, where it breaks that apart, where you take the original UTX token and you break that into two pieces, one piece representing ownership of the token, which has its own market that's just ownership, but then the other piece becomes the utility, which has its own market. And like you mentioned before, you now have this opportunity for price discovery of just the utility. So when and in using the IBC, Wax, for example, a smart contract on Wax doesn't need to buy a bunch of UTX tokens. They just need to come and use the IBC bridge and just acquire the actual utility, the actual network consumption required to run their DApp.
Yeah, exactly. So we can do it that way around. And also what utility, because of the bridge now, what UtilityX can do is take, say, a Wax token and take that through the bridge. But well, technically it doesn't take, wraps it, but what it can do is it can split the Wax token into TU and we call it TU and TC, sorry, but into utility and capital. And then that can be traded on UtilityX in its wrapped form, in its bridged form. So anyone that wants to acquire, anyone, now we can actually allow users to acquire resources on Wax without acquiring the Wax tokens. They can actually acquire the utility bits. So we can do the same, and you can do the same thing for Telos. EOS is slightly different because it has the power up model, so they flipped the relationship to gas, but my goal is to convince them to go back to the old version. So,
well, this will be, well, you'll see why, perhaps, right? How this plays out, and once this gets built up, and then there might be it'll be kind of apparent why perhaps they should switch back if that's the better way to go.
Well, most people, again, it comes back to the argument that people will say, "Hang on a minute, if you're able to do that, where's the demand for tokens come from? Like what, and for me, it's a long-term game. It's like, you're not going to get a squeeze in the token price that jams it up 10x every time someone wants to, use 10% of the resources. And it's incorrect mathematics anyway. But like, and not talking about EOS, I'm talking about generally, like putting these convex curves in kind of like to kind of jam up the cost of using a chain. Like it makes no sense. And Ethereum is the kind of obvious kind of protagonist in that matter. But if you establish this dollar yield on utility, the capital value of the token will take care of itself. Like markets will find that level. It might take a little bit longer, but in the long run, you will, because you've taken that route. I'm convinced of it. That's the way to do it.
And it hasn't been done yet, especially in a performant blockchain like Eosio. So this is where you're kind of cutting edge from that respect, right? Because this is a fully new economic model that is quite rational in how you've done it.
It's because I think we're lucky, like all of my team have experienced, good and bad real world business and understand what works and what doesn't work. And if you said to someone, you're renting my office, right? And I'm going to rent you an office, right? So you're going to pay me like $10,000 a month in rent. Like, so the first month, you pay me the $10,000. The next month, I give you the bill and it's $100,000 because a load of guys have moved in upstairs. What are you going to say? Like, what's this all about? It's like, oh, that's blockchain. Like, yeah, that's the way it is, I'm afraid.
Sorry, no regulation.
Yeah. And so you're going to like, I'm never going to rent this place again. I'm going back to WeWork. And, so I don't know, like you have to take real world practice and go, does it, all right, we can get away with certain things. And yes, there's limitations to the technology. Yeah, I get that. But stuff like that, it's kind of common sense. Like you gotta be, if you want the adoption, which I'm not sure everyone does, the way these kind of these businesses operate. But if you want the adoption and that's what you believe in, then you got to make it easy. And you got to make it in line with commercial practice, which is, again, another challenge in a lot of these things, as we kind of, dealt with QED, with the kind of recourse model. But you have to kind of, there's a balance. There's great innovation in crypto, but some of it is antithetical to doing business, and so you have to blend that and balance that. And I think that's kind of one of the things, because we've done lots of different things and we kind of seen lots of different things, as we understand, these are the sensitivities you need to manage. And so we're kind of quite lucky in that respect.
Well, and you mentioned one more thing, and before we wrap up, you mentioned QED, which those who don't know, that's your decentralized collateralized oracle, which is going to be huge, right? And so that was mentioned in a recent article. Comar. I forget the name of the article desk that carried it, but so that came up. And the other thing that you've got on your platform is the async decentralized, it's an identity manager where you do KYC. And then again, now using this IBC, you're going to be able to pull those KYC identities more than likely into other chains. So other chains can now leverage that KYC, right?
Well, yeah, I mean, my idea about, so originally, I think people believe that we're kind of obsessed with compliance and KYC, which is, I can tell you, it's far from the truth. It's actually one of the most boring subjects of all time. But well, I find it boring. The identity for me was always interesting. Like, the ability to kind of like, so having a transportable KYC was, a passport, if you like, was always very interesting. So the ability to kind of port your KYC through different applications basically that require KYC in terms of, and it comes back to user friction. You join a kind of centralized exchange, you're 2 hours uploading your driving license and your utility bill, and then you're waiting for the manual review because you didn't put it in properly or whatever, or this, whatever it is. Mm-hmm. That's in a world where there's not many exchanges that you can use, say, for trading crypto, you kind of live with it. But in a world where you're going to A or B, you don't want that, that experience of leaving a user waiting around. It's kind of like, if you could avoid it, you'd avoid it. So the ability to then have KYC as a passport, like to literally be, effectively whitelisted to use an application because you've gone through KYC, for me was very interesting. We've got quite a bit to work to do on the KYC side of things anyway, which we're looking at quite closely in terms of developing that passport. Guillaume's got some kind of like pretty cool stuff up his sleeve with decentralized KYC, which I won't speak for him, but it's very interesting. But there's also there's another part of identity which I think is useful, which is the economic value of identity, being able to model the economic value of identity in any network, and that comes back to what we talked about earlier. Like, if you take Ethereum as an example, if you talk about the value of a token, just think about the value of a token like Ethereum. You can value it in 3 ways. You can say, okay, what's its utility value? What's its currency value? And what's its identity value? So in the case of Ethereum, you take these 3 assets, and you could say, well, utility value is negative because cost a fortune, it's slow, it's only going to drive users away. Currency value is what it is. You've got to use Ethereum to use Ethereum, so you kind of know where you use Ethereum. But, all right, there's a kind of market making spread, if you like. You've got to buy the token, pay some guy dollars, who's then going to buy it back with someone else. And so there's a kind of transactional value that feeds back into the system. So there's some value there. Okay, that's fine. The third part is identity. No one ever talks about identity value, but identity value is what you go to Ethereum for. You go there because on Ethereum there's a lot of people with a lot of money to spend, and that's what And if you think about any traditional business that wants to acquire users, they care about what's the value of the user that they're acquiring. Betting companies will buy users, give you $30 a user. That's how they model it. Why is it $30? Well, there's a probability of they'll stick around for 3 months, they'll spend X, they'll lose Y, whatever it is. So there's a kind of probabilistic analysis of any user. Well, it gets really interesting in a blockchain because you have much more transparency over the user's economic activity if you can model their identity. So we've actually developed a token model for identity, which we haven't released yet, which we will do eventually and fold into the whole async as a kind of identity oracle protocol. But if you can model the capital value of identity in your network, it enables, again, if you're thinking about launching an application, where you want to launch the application. So we spoke about how can I plan my resource allocation in terms of dollar spend? Okay, I can do that. But how can I be very precise with my user acquisition and user retention models and know basically, what's my marketing spend? What is my user acquisition strategy? Well, an identity model gives you a much greater, much greater visibility of what that economic value is and value back to you. Exactly. What am I buying? So, and again, the more tools that you create like that, I think, you get this kind of crescendo effect where you'll get more applications because they have more visibility over what these kind of values are, and also more users, because you kind of recycle these benefits of identity and capital value back to users. So you can actually grow, there's a very clear, no one else is doing it. No one really looked at this. And I think that's a kind of nice bit of USP that we have potentially in UX network. So an Ethereum token kind of represents, those three assets all bundled into one. But if you decompose them, the parts are greater than the discounted conglomerate, basically, is the way I think about it.
Sure. And other applications get to leverage those outputs as well, right? Like because like you say, ID, not that sexy, but to an application that requires KYC, excellent. This makes your chain, or the Eosio suite of chains, a much more attractive place to go to deploy your product that can leverage this integrated KYC.
Well, yeah, if you can model identity, like the capital value of identity, fundamentally, if you have a KYC user is fundamentally worth more than a non-KYC user. I mean, that's just a fact, because and there's some kind of corollary benefits to that as well. But all of KYC is this kind of like is just this economic tool that we look at as identity as a much broader asset class. And that leads you into some kind of other interesting places, who owns your identity and which can go on all night about. But there's some interesting stuff that we have, which I think we try not to do, and I don't know whether this is on purpose or it just happens, but I don't think we do the same as other people, and we're always looking to do things in a slightly different way. So
something to be
with a kind of unique. Sometimes there's
well, you're a contrarian, so I mean that's kind of just makes sense.
I hope so.
No, that makes a lot of sense to me, Daryn. I think what you've got going on here is excellent. To the users, we've mentioned a lot. There's a lot going on, and so this isn't meant to be it's not all coming out next week. This is going to take some time, but I think the first big step is going to be probably your AMM, and then I think that then feeds into the ability of this super token, and I think more information will come out about that. I understand there's a very reasonably complicated white paper and some mathematical formulas that go along to demonstrate.
I didn't do the maths.
Yeah, well, no, but it's legit. This is real stuff. This isn't just hokey pokey ideas in the sky. And this is ideally going to turn into something very tangible that is the direct beneficiary will be the Eosio ecosystem. Those who watch this and you're on Wax or you're on Telos or you're on Eos and you still have this combative approach that, screw them, it's our chain. This is going to maybe open your eyes and give you an opportunity to diversify without having to buy these individual tokens. You just acquire this, not financial advice, but you acquire this set token or super token, and it gives you exposure to the underlying basket of tokens. And that's amazing utility for an ecosystem.
Yeah, I think that's right. Yeah, I think that's right.
Cool. Anything else you want to say before we hop off?
I'm good. Thank you.
Awesome. Okay, well,
I don't think I'll be doing many more of these. So yeah.
Well, I don't know. We might get you back. You're a fun guy. So as more comes out, I think hopefully I'll get something going to demonstrate your AMM. We'll do maybe a bit of a how-to, maybe with Guillaume, but definitely looking forward to following your progress and your team's progress and supporting you along the way. So thanks for your time.
Thanks, Chris.